Hello, I'm Finola Burke from RaaS, and today our focus is on vehicle subscription business, Carly Holdings, ASX ticker CL8. And joining me is Chris Noone, the CEO of Carly Holdings. Welcome, Chris. Thanks for joining us. Now, Carly reported a 76% increase in subscription revenue in Q3 FY23 over Q3 FY22, and a 21% increase over Q2 23. And your average monthly subscription revenue reached $189,000 in the quarter. What have been the learnings you've gleaned in this period?
What we've shown is that we've moved beyond the issues that were previously in the market about supply of vehicles. Previously, we were saying that we had concerns about the ability to order and receive quick delivery of vehicles. We're now receiving very quick delivery of vehicles. Sometimes those vehicles being delivered 2 weeks from order. The most recent finance facility we've secured, we've also received delivery of over 30 vehicles from that as well. So we now know that we've moved beyond those issues, that we can get cars as soon as we have finance available. We also saw the revenue increasing every month throughout the quarter as well. We've also seen some good additions of vehicles to our asset light fleet as well. So we have the Ioniq 5 electric vehicles from Hyundai. They are achieving very good prices. So we're showing that we can grow our asset heavy fleet and also our asset light fleet as well.
And subscription vehicle utilisation rates remain very high despite bringing on a number of new vehicles. Is this being driven by pent-up demand, and is this sustainable in your view?
For quite a while, we've had a lot more demand than supply. So it's really pleasing that we can add vehicles to the fleet fairly quickly. We also feel that most people and businesses don't even know that car subscription exists. So there's a massive opportunity for us to educate the market. And we think that there is a lot more demand for car subscription. We've barely tapped into the corporate market yet. We have plans to bring on a corporate sales manager to help us move more into that market. So there's a lot more growth that we can see in the business market. Also in the consumer market, for many of the weeks during the quarter, we actually turned our marketing right down because we were getting enough organic traffic through our website that we didn't need to spend much money on marketing. In some weeks, we were spending less than $1,000 a week on marketing. So we know that there is scalability in our marketing campaigns, and we know that there is also massive potential in the corporate, government and not-for-profit markets as well.
That's a nice segue into my next question, because you kept a lid on costs in the quarter. So advertising and marketing, as well as product manufacturing and other operating costs were down 17% on the December quarter and a similar level on the PCP. Looking forward, do you think you can sustain these cost levels, or will there be a need to increase your advertising and marketing spend and other costs?
We always try to scale the business through technology rather than adding lots of headcount. We will have some modest headcount increases during the FY24 period. And that's because we physically do need people to hand over cars. We do need people to work on our website. We need developers. So we'll be bringing people in on the operational level, on the technology development level, but also on the sales side, as I mentioned, with that corporate sales opportunity. In terms of advertising and marketing, we've been not only bringing down the total cost, but we've also been bringing down the cost per acquisition per customer. So on that per customer basis, we think we will now be relatively flat in terms of our costs. So as we scale the revenue, yes, the cost will increase, but it will be in proportion to the extra revenue that we're receiving from those customers.
And you now have in place your $10 million facility, as you mentioned earlier. When do you expect to have this fully drawn, and what does business look like at that point?
We'll be drawing this down as quickly as we can. We've already drawn down $1.2 million. We've received a delivery of over 30 vehicles already, and there are more scheduled for delivery this week. So once again, we're seeing that as soon as we order vehicles, we can get them very quickly. When this facility is fully drawn, we expect it to be able to deliver around 450 vehicles. And based on our average revenue that we've reported previously, if those vehicles were utilised at 87%, it would be delivering $4.7 million in annual revenue. And that's on top of the existing revenue run rate that we had in the last quarter, which was $2.5 million. So this would be a massive increase in the revenue for the business. And as you alluded to previously, we're pretty good at keeping a handle on costs. So it means that, we are delivering a lot more to the bottom line of the business.
Well, Chris, thank you very much for joining me today. I'm looking forward to catching up with you through the course of 2023 to check on Carly's progress.
Thanks very much, Finola.